Okay, let's go ahead and start. Ladies and gentlemen, I've been in this business between tax preparation, financial planning, probably going on now about 35, 40 years. And in these 35, 40 years, the past 6 months, there's been more legislation I've seen than probably in any other year. This past 6 months, it's just there have been so many changes for one reason or another, and a lot of these changes, I have to admit, do not affect most federal employees, but there are some that are particularly important, and I'll be concentrating on those changes and just talking about them. What I'm going to be doing today is I'm going to first give a very general presentation of what the Secure Act and CARES Act resulted in, the various parts to them, very generally. Then we're going to go through each one and talk about the important parts of the legislation that affect federal employees and retirees. And then along the way, I hope you will put your questions in the chat box. And what I want to do, Dolores, if that's okay, is when I finish talking about the Secure Act, we'll take the questions at that point, okay, and then get back into the CARES Act. People can take their questions as I'm talking, and then we'll take the questions about the CARES Act rather than waiting to the very end to take the questions, because I want to get to the questions for each particular piece of legislation, if that's okay. And then the last thing I want to do today is talk about the opportunities that have come about as a result of this legislation. When I say opportunities, there are some things that have happened that have resulted in opportunities for federal employees to take advantage of what I call the down stock market, lower tax rates. And I want to just go through some of these opportunities that really will be to their advantage and to their loved ones, the beneficiaries of their retirement accounts. And we'll do that at the very end. Okay, so with that, let's go ahead and get started. Let's talk about the first act, the Secure Act. Secure stands for the Setting Every Opportunity Up for Retirement Enhancement or Secure Act. It's amazing how they come up with these acronyms. It was passed into law by Congress in December 2019. Actually, it had been sitting in Congress for months. I believe the House passed it back in April 2019. It was like a vote of something like 417 to 2. And then it sat in the Senate for months on end. And finally, in December 2020, December 2019, it was passed and signed into law by the president. It was really the first major retirement legislation enacted since the 2006 Pension Protection Act. Nothing really of significance was passed between 2006 and 2019. Probably the most important element of the bill, and this is where federal employees and people who work in private industry were most interested in, is that the minimum age for required minimum distributions. Here's this acronym: RMDs, MRDs, minimum required distributions. When do I have to start taking money out of my retirement account? When do I have to start taking money out of my traditional IRA? Everybody was geared with the idea of age 70 and a half. Well, it was raised to age 72. For a lot of people, that was good news, but it does not affect everyone because they Congress did in fact grandfather it, and we're going to get into particulars who this bill, what this legislation did in terms of raising the MRD, who's affected. It also allows workers to contribute to traditional IRAs after age turning 70 and a half. Before this legislation, when you reach the age of 70, even if you were still working, maybe you retired, but you had a spouse who was working. The one requirement to contribute to an IRA is that you or a spouse has to have earned income, a salary, or maybe you're self-employed and you have a net income for your business. Even if you were working at age 70 or older, you could not contribute to a traditional IRA. That was changed with this legislation. Third thing it did, it allowed individuals to use 529 plans. These college savings plans take distributions from their 529 plans to repay student loans. Before this legislation, the only thing you could take money out of the 529 plan was to pay tuition, fees, room and board for your son or daughter when they went to school. Now the money can be taken out to pay down student loans. Eliminated fourth thing, eliminated the so-called stretch IRA, another significant change. Before this happened, we had this concept of a stretch IRA. You could name a child, a grandchild, as beneficiary of your traditional IRA, your Roth IRA, and in so doing, that IRA could last almost forever. Now, with this legislation, it eliminated certain beneficiaries from receiving, being able to take a lifetime distribution from that IRA. And the fifth thing it did, and this really does not affect federal employees too much, it allows 401k administrators to offer annuities as part of the options to take money out of the retirement plan. The CARES Act. CARES Act stands for the Coronavirus Aid, Relief, and Economy Security Act. It was passed into law by Congress in March 2020. It was part of a $2 trillion stimulus bill in order to blunt the impact of an economic downturn set in motion by the global coronavirus pandemic. Major elements of this CARES Act that affect individuals were direct cash payments of $1,200 to single individuals. Certain individuals were able to get stimulus payments, $1,200 for a single person, $2,400 for a married couple, with an additional $500 payment per child. However, if your adjusted gross income was over a certain amount, you were not eligible to receive these payments. So there was a limit. I think for single people, if your adjusted gross income in 2018 or 2019 was over $75,000, you got some, but not all. Once you reached a certain amount, I believe 99,000 in the AGI, you did not get a payment. And for married individuals, the phase out started at $150,000. For 2020, anybody who is subject to mandatory minimum required distributions, MRDs, RMDs from their qualified retirement plan, through retirement accounts, that included the TSP from their traditional IRAs, would not have to take their RMDs in 2020. RMDs were suspended for the year 2020. Anybody who's not taking an RMD in 2020 is not going to be penalized. Now, this has caused tremendous amount of confusion among people, because there are some people who did, in fact, already take their RMDs before this law was enacted. And we're going to talk about what IRS did in order to make amends for these individuals who already took their RMDs. Individuals are allowed to take during 2020 to take distributions from their qualified retirement plans of up to $100,000 and not have to pay a 10% early withdrawal penalty. They don't have to be 59.5. They can take the money out. It's not considered to be a hardship distribution if, in fact, it is a so-called corona-related distribution, a CRD. We're going to talk about what that means. And who is eligible to do that, because not everybody can. All right, so let's go through the specifics of the Secure Act. Things I went through. I want to go into a little more detail. What some of the specifics of each act. Effective January 1st, 2020, the Secure Act eliminates the age limit for traditional IRA contributions. It used to be when you reached the year you turned 70.5, that year you could not make a contribution to a traditional IRA. Whether it's a deductible traditional IRA contribution or a non-deductible traditional IRA contribution, you could not do it. You could, however, contribute to a Roth IRA. Roth IRAs have never had age limitations. The only requirement to contribute to an IRA, and this includes a Roth IRA, is that you or a spouse, if you're married, has earned income. What is earned income? A salary, wages, you're being paid. You're getting a salary. Maybe you're self-employed. You have a net profit from your business. You would be allowed to contribute to a Roth IRA if you're over 70 and a half. When you are if you were before January 1st, 2020, if you were still working or you had a spouse who was still working, the year you reached 70 and a half, no traditional IRA contributions were allowed. Now, getting back to the Roth IRA, one of the restrictions with the Roth IRA is that if your adjusted gross income is too high, now adjusted gross income, think of it as total income. Total income. It's before any deductions. It's the total income you receive. It includes your gross salary, includes interest income, dividends, capital gains. It's your total income. Maybe some minor adjustments to income. Maybe if you have some adjustments, for example, you put money into your health savings account, that will adjust your income. But just think of it as total income. If your total income is too high, you are not allowed to contribute to a Roth IRA, no matter what your age is. With the traditional IRA, there are limits for contributing to a traditional deductible IRA. What do I mean by a traditional deductible IRA? When you contribute to a deductible IRA, the contribution you make is an adjustment to your income. It reduces your gross income, meaning you're going to pay less in taxes. They also have income limitations. But the other type of traditional IRA, a non-deductible traditional IRA, the contribution you make does not result in deduction. There are no income limitations for making a contribution to a non-deductible traditional IRA. The only thing you've got to keep in mind is any year that you contribute to a traditional non-deductible IRA, you have to file IRS Form 8606. That's non-deductible IRA contribution to tell IRS that the contribution you made was already taxed. Now, what does this have to do with age 70 and a half? With the suspension, now permanent suspension of the age, the removal, I should say, of age 70 and a half for making a traditional IRA contribution. Let's suppose an individual is 70 or older and they have earned income, or they have a spouse who's still working. And for 2019, for the year 2020, which we're in right now, they know that their income is going to be too high to allow them to contribute to a Roth IRA. They're over the limit. They're going to have too much income. What this new law, what it means is that an individual can always contribute to a non-deductible traditional IRA. It's 2020. This individual can now contribute to a non-deductible traditional IRA for 2020 and then turn around and convert it to a Roth IRA. It's called a backdoor Roth IRA. Why backdoor? Because you're not coming into the front door. You're not contributing directly to the Roth IRA. You are contributing to the non-deductible traditional IRA and then converting it to a Roth IRA, coming into the back door. And if you do that conversion right away, then you won't have to pay any tax because the contribution you made was made with after-tax dollars. With after-tax dollars, the result is that you will not have to pay any tax on the conversion. And now you have yourself what's called a converted Roth IRA that now is going to grow tax-free. So this opens up opportunities for those people who are going to be older than 70 who cannot contribute to a Roth IRA because their income is too high. Great opportunity. One of the most popular changes here came about, it's on the screen, the required minimum distribution RMD age was raised to age 72. The Secure Act raises the age for starting required minimum distribution RMDs to age 72 for all retirement accounts subject to RMDs. I emphasize the word all. Any type of qualified retirement account, and that would include a 401k plan, a 403b plan, the traditional TSP, the Roth TSP, a traditional IRA. All these plans, when you reach a certain age, you are required to take out what's called an RMD every year. Every plan that you have, every plan that you have participated in, when you reach a certain age, you have to take an RMD for each of these plans. Before the change in the law, everybody had to start taking their RMDs no later than April 1st following the year they turned 70 and a half. That's called the required beginning date, the RBD, the required beginning date. Well, with the Secure Act, anybody who was born after June 30th, 1949, your required beginning date is April 1st following the year you turned 72. April 1st following the year 72. So if I may, can I give an example? My own personal circumstances. I was born on January 17th, 1951. I was born after June 30th, 1949. So I am now under the category of the RMD in this age 72 class. My required beginning date is April 1st, if I've done my math correctly here, April 1st, 2024. Why? Because I'm turning 72 years old on January 17th, 2023, which means the April 1st following that year that I'm turning 72 is my required beginning date. In other words, I have an extra 2 years to take now my first RMD. Now, what do I have to take my RMD from? Well, right now, the only thing I have two types of accounts that are subject to RMD. One, I have my TSP. I retired from federal service back in 2006. I've kept my TSP and I've not touched it, but come April 1st, 2024, I have to take that first RMD no later than April 1st, 2024. And by the way, if anybody has the Roth TSP, the Roth TSP is also subject to RMD, but there's a way around that, which if I have time, I'll talk about that a little bit later, how you can get around that problem of your Roth TSP being subject to required minimum distributions. So this is a welcome change. Now, if you were born before July 1st, 1949, your required beginning date, again, is April 1st following the year you turned 70 and a half, okay? 70 and a half. So they didn't change, that was not changed for people who were born before July 1st, 1949. I think I've talked about this in person. I've been giving some seminars. There's this thing called qualified charitable distributions, QCDs. Now, what are QCDs? Taking a little deviation here, somewhat. Let's go back to the required minimum distributions, RMDs or MRDs, minimum required distributions. One of the ways you can avoid having to include your minimum required distributions, your required beginning distributions in income is by taking advantage of what's called a qualified charitable distribution. And what a qualified charitable distribution is, if you have an IRA, a traditional IRA, you can direct, if you're over 70 and a half, that the money coming out of the IRA be directly sent to your favorite charity. It could be a church, it could be a synagogue, it could be a mosque, it could be the Goodwill, it could be it could be a museum, any nonprofit organization, any house of worship. And if that payment comes, again, coming out of the IRA, it has to come from the IRA. If that money goes directly to the qualified organization, it will count as an RMD. It will count as an RMD, and best, it is not included in income. Now, you don't get a tax deduction for that. You won't be able to write that off as a tax deduction, but most importantly, it's not going to be included in your income. When it's not included in your income, that means you don't have to pay tax. Also, for those of you who are over 65, enrolled in Medicare Part B, not being included in income might mean that you may not have to pay that much for Medicare Part B, because the way Medicare Part B premiums depend on what is called your modified adjusted gross income. Okay. So these qualified charitable distributions are a great way to fulfilling your RMD obligations every year and not having the money included in income. I want to say that under the Secure Act, the age at which you can do a qualified charitable distribution is still 70 and a half. Even though they raised the RMD age to 72 for people born after June 30th, 1949, the age in which you can do QCDs is still starting at age 70 and a half. Again, it has to come from your IRA. You cannot make a QCD from your TSP. It has to go from the IRA to qualified organization. And this slide here basically talks about leading advisors know that qualified charitable distributions are an increasingly popular option for clients looking to use the standard deduction. What does that mean? Under the Tax Cuts and Jobs Act of 2017, the current tax law, a lot of people are not itemizing. They're taking the standard deduction because the standard deduction was doubled. So they're not itemizing anymore. They're not taking the standard deduction. They cannot include their charitable contributions because they're just taking the flat. Part of itemized deductions are your charitable contributions. So if you're taking the standard deduction, you cannot get a deduction for any charitable contributions you make. However, with the QCDs, you are not getting a deduction for making charity, but it's not being included in income. So it's a way around this thing of not getting any type of write-off for your charitable contributions, but most importantly, it's not included in income, okay? I just want to warn everybody, there's a trap here. A few moments ago, we were talking about the fact that if you're over 70 now, you can make traditional deductible IRA contributions. There's a trap here in the following sense, that if you make a contribution, if you make a contribution to a traditional deductible IRA or over 70 and a half, you get a deduction. Then you, a few years later, use that contribution you made to the IRA as a QCD, you're going to shoot yourself in the foot. I say that because you cannot have your cake and eat it too. Here you took a deduction for your contribution to the IRA, and now you want to take another deduction for getting credit for your RMD. You can't have it that way. So my advice is that if you're interested in doing QCDs, please, if you're over 70 and a half, only make contribution to Roth IRAs. And if you're not eligible to do a contribution to a Roth IRA because you're over the income limit, like I said earlier, you can always make a non-deductible traditional IRA contribution, file the form 8606, telling IRS my contribution was not deductible, and then in turn, convert the IRA immediately to a Roth IRA. Roth IRAs are the best thing for people over 70 and a half for a lot of reasons. And this is just one of them. Continuing with the Secure Act, we have a new exception to the 10% penalty for taking money out of your IRA. Starting January 1st, 2020, if you take money out of your IRA or qualified retirement plan. Up to $5,000 you take out can be used to pay for the birth of a child or the adoption of a child. To qualify, the distribution must be taken within 1 year from the date of birth or when the adoption is finalized. A married couple can each take out $5,000, so that means $10,000. It can be repaid, okay? It can be repaid. My feeling about this is, I'll be very honest with you, ladies and gentlemen, I'm not a big fan of this. We shouldn't be rating our retirement accounts to pay for present day needs. Just like you don't take, in my opinion, money out of your TSB or an IRA to pay for a car or to pay for a college education for a child, because this is your future. Yeah, I know the withdrawal is penalty free, but it's still taxable. And most importantly, once it's out, and then it's going to be losing all the potential earnings once it's out. Yeah, you can repay the account. Yeah, it can be repaid. Okay, it can be repaid to any type of account, a retirement account, including the TSB or traditional IRA. But the fact is, ladies and gentlemen, how many people do you think are actually going to do that? They see this as an opportunity to take money out of the IRA. Oh, now I can pay for my child's birth, birth of my child, or the adoption of my child. I don't think it's a good idea, but it's there. There are expanded benefits for 529 plans. Fellowship and stipend compensation are now basis for IRA contributions. Secure Act expands 529 college education accounts to cover costs associated with registered apprenticeships, and up to $10,000 for you can use money coming out of your 529 plan to pay for for qualified student loan repayments. In addition, starting for the year 2020, if you have a son, a daughter, friend, niece, nephew who had let's say a fellowship, or a postdoctoral student, something like that, maybe they worked at NIH or another institution, did a fellowship, that money can be used, the money they receive can be used as a basis for contributing to an IRA. Beforehand, the money they received as a fellowship or a stipend was not considered to be earned income, and could be used as a basis for contributing to an IRA. The end of the stretch IRA. With any death occurring after December 31st, 2019, the stretch IRA is replaced with a 10-year payment rule for the vast majority of beneficiaries. Let me go back and explain what had happened before they changed the law. Let's suppose you are a parent, a grandparent. You own an IRA, traditional IRA, or Roth IRA, and you'd like to give a gift that will last forever to a child or a grandchild. Well, what you could do is you could name such a child, grandchild, as beneficiary of your IRA. And you could set it up so that when you passed away, that the proceeds of your IRA to this child beneficiary, grandchild beneficiary, would be transferred to what is called an inherited or death IRA. Now, what's the benefit? What is the real benefit here? We talked about earlier that when you reach 70 and a half, you got to take RMDs, requirement of distributions. Well, and that does not include a Roth IRA. But a Roth IRA in particular, is not subject to RMD. However, if you name a non-spouse as beneficiary of your traditional IRA or Roth IRA, the rule is that the beneficiary has to start withdrawing that money. In fact, they really have to get it out within 5 years. But they do have the option. This is before January 1st, 2020, before the Secure Act was enacted, to roll the money into what's called a death or inherited IRA. And in so doing, they had the option of having the required minimum distributions paid out over their life expectancy. Now think about this. Here you have a 10-year-old grandchild, and you name that 10-year-old grandchild as beneficiary. You set this up in a trust, a beneficiary through a trust. The trust says the money will be paid out to this grandchild over his or her life expectancy. What's the life expectancy of a 10-year-old? What, 75 years? And for the next 75 years, this grandchild will be getting a payment each year. This is true whether it's traditional or Roth, because Roth IRAs are subject to RMDs when they're inherited by a non-spouse. It opened up lots of great opportunities. The lawyers who were preparing these trust forms to do such a thing were busy as can be. But now with the Secure Act, things came crashing down because we have a new rule now. If you name what's called a non-qualified beneficiary, now this is someone who cannot take a lifetime distribution. We're talking about children. We're talking about children, grandchildren over the age of 18. They have a 10-year payout distribution. Once the 10-year mark comes, this is after the death of the original IRA owner, the money has to be paid out in full to the beneficiary. Again, whether a traditional IRA or Roth IRA. This is true for deaths occurring after December 31st, 2019. Any deaths that occurred before January 1st, 2020 are still subject to the old rules again, the so-called stretch IRAs. It really has caused some great a lot of changes here, and the lawyers have been very busy trying to getting around the change. I mentioned about the end of the stretch IRA, about the so-called eligible designated beneficiaries. The 10-year rule does not apply to all beneficiaries. There are 5 classes of eligible designated beneficiaries who are exempt from the 10-year post-death payout rule and can still stretch their RMDs over their life expectancies. These include surviving spouses, minor children, but not grandchildren. When I say minor children, they're younger than 18. But however, keep in mind, once that child turns 18, they have to take the money out by the time they're 28. They have a 10-year payout. Disabled individuals, chronically ill, and beneficiaries that are no more than 10 years younger than IRA, like siblings, for example, who are within 10 years of the IRA owner's age. They can take it. The eligible designated beneficiaries can stretch the inherited IRA over their life expectancy. Okay. I think, if it's okay, Dolores, I think I'd like to have some questions based on what I've talked about so far about the Secure Act.
Okay, I'm coming back.
Okay.
Hi, everyone. Okay. First of all, yes, the webinar is being recorded. That's one of the first questions we received. So that's the answer to that one. The first question is, Ed, how much can my spouse and I give to our children without tax consequences? Do we need to report something to the IRS?
So Dolores, we're talking about just a straight gift, This is
I would presume so. Isn't there a limit on that, 15,000?
It's $15,000 per individual. So if the person asking the question is, I assume, is married. So let's suppose, I assume they're married. So
yes, he is. Oh, he or she is. How much can my spouse and I give to our children without tax consequences?
Okay. So in 2020, a married couple can each spouse can give 15,000 to one child. So that's a total of 30,000 for both spouses to one child. If they have 4 children, that means they can give a total of 120,000. Because in terms of total, 30,000 per child from each spouse. Now, that doesn't mean that they're going to have to stop at 15,000. They can go over 15,000, but if they do, they're going to have to file a United States gift tax return, IRS Form 709, next spring. Will they have to pay any gift tax? No, because during your lifetime, an individual can gift, under current law, up to $11,800,000 of their estate while they're living. A couple, you can double that to $23,600,000. They want to, and then anything above the 15,000 will subtract from their exemption. It's tied in with the estate tax exemption. So again, there's unlimited here amount, so to speak. We just got to remember that if you go over the 15,000 per individual, you have to file that IRS United States gift tax return, IRS Form 709, next spring.
All right. Okay, thank you, Ed. I just want to say to everyone that if you have questions, my colleague Christine Miele is also. You should actually send your questions to her from this point forward, because while I'm interacting with Ed, I'm not going to be able to keep up with what comes in. And we have a goodly amount of time for questions, so by all means, send them in and send them to Christine Miele. Okay, next question, Ed.
Yes.
What if we buy a 529 for a grandchild for a $60K lump sum? What are the tax consequences, and is there any reporting to the IRS needed in that case?
If you, this is for a child, that's for child.
For a grandchild.
For a grandchild.
Yes. I'm sorry.
Most 529 plans allow you to give the equivalent of 5 years worth of gifts to one child. So we're talking about 30,000 per couple. So that would mean in 1 year, a couple could give potentially $150,000, could contribute $150,000 to that 529 plan and not have to worry about any gift tax or gift return reporting. So if you have 5 children, if they have 5 grandchildren, they could give a total of $750,000. Again, this would not go against their estate exemption. Okay, estate exemption. And there's no income tax. There's no income tax consequences. There's nothing reported on the income tax return. What they may want to find out, though, the couple, is if they live in a state that gives some tax benefits for contributions to the 529 plan. For example, I live in Maryland. I have clients who contribute to the Maryland 529 plan for their grandchildren. They get a deduction for the amount that they contribute to the plan. So they should check with the state that they're contributing to see if there's any state tax, either a credit or a deduction.
Okay. Next question. Ed, one of our participants says, I'm trying to understand this backdoor Roth strategy. Right now, I have to pay taxes on my thrift savings plan withdrawals. If I take money from the TSP and then out of the TSP and then use the backdoor strategy to put funds in a Roth IRA, does that mean I no longer pay taxes on the withdrawals, even on the earnings on that account?
So the individual, Dolores, if I understand the question correctly, the individual wants to contribute to a non-deductible traditional IRA, and then in turn
talking about the backdoor strategy.
The backdoor strategy, okay?
Yes. Are you having a hard time hearing me? Do I need to repeat the question?
No, I just want to make sure I got all the facts straight.
Okay. Yeah. She's talking about if she takes money out of her TSP and then uses the backdoor strategy to put it in a Roth IRA, does that mean she no longer pays taxes on the withdrawals, even on the earnings on the Roth IRA account?
Once it gets inside the Roth IRA, it's going to grow tax-free, okay, tax-free. And she can withdraw the funds from the Roth IRA down the line and not have to worry paying federal or state tax, both on the contributions, the money that was rolled in, and also the accrued earnings. Yes, yes.
But when she or he takes the money out of the TSP, do you need to pay taxes before you put it in the?
Yes, you first have to take the money out. It cannot go directly from the TSP. You can't do a direct transfer from the TSP and use to contribute to a Roth IRA. Okay.
So what does the backdoor strategy actually mean then? I'm not clear on that.
Okay. So let's, and I gotta just back up here with the question. When the person is taking money out of his or her, let's say, traditional IRA,
right,
and they want to transfer it to a Roth IRA, that is not a backdoor Roth IRA contribution. That is a rollover. That's a transfer. That in itself is fully taxable, federal and state. Now, once that money from the traditional IRA goes to inside the Roth IRA, again, taxes have to be paid, but it'll at that point it will grow tax-free. The money will come out tax-free. The backdoor Roth IRA is altogether different. Let's review again the scenario. Makes no difference what age you are. Here, you have in 2020, your income is too high. Your income is too high. What is too high? Let's suppose, all right, Dolores, can we use you as an example?
By all means.
Okay. Dolores, how do you file your taxes? Single or married?
Single.
Okay, single. So Dolores, I can tell you for a fact, I don't care what your age is, makes no difference, because you're still, if you have, let's say you have earned income this year,
Mm-hmm.
If your earned income in 2019, because you still have time to contribute to a Roth IRA, you know that. The deadline's July 15th. We got 3 weeks, we got like a couple weeks to go. Let's suppose your 2019 adjusted gross income is over $135,000. You are not allowed to contribute to a Roth IRA, Dolores, because your adjusted gross income is too high. But you would be eligible to contribute to a non-deductible traditional IRA because there are no income limits. So here's what you're going to do. You're going to contribute $6,000 or $7,000 maximum if you're over 50 to a non-deductible traditional IRA. You go to a company like Vanguard or Fidelity or T. Rowe Price. I'm just throwing out some companies now, and say, I want to open up a traditional IRA. Okay? You put in the $7,000 between now and July 15th. You file the IRS form 8606, telling the IRS that $7,000 was already taxed. And then 2 days later, you contact Vanguard, Fidelity, T. Rowe Price. I want to convert this traditional IRA to a Roth IRA. You're converting the $7,000. The $7,000 has already been taxed. You will not pay any tax. Now you have for yourself, Dolores, a Roth IRA that you didn't pay any tax on when you converted it. That's why I say it's called the back door. Dolores, you cannot come into the front door. Your income is too high. You have a very special problem. Your income is too high. May we all be blessed with such a problem, right?
Right.
So we come into the back door. People have done this all the time. Congress, thank goodness, did not get rid of that opportunity, coming to the back door. The person who asked the question was talking about a transfer. that's not a backdoor conversion.
Okay.
It's a
All right.
transfer.
Well, that's
the
good to
difference.
really have that clarified. Thank you very much, Ed.
Okay.
Okay, we have the next question. Can we briefly cover again this point? For individuals considering both a deductible contribution to a traditional IRA at age 70 and a half or older and a QCD, professional tax guidance is essential?
I'll be very honest with you, Dolores. I would recommend that before you do either one, you talk to a tax professional, because you really don't want to regret what you did down the line. I'm running into too many problems now as an accountant where people got the wrong advice or did it on their own when they should have gotten advice years ago, and they're paying the price now. We're talking about some very, very delicate, intricate things that only a qualified tax professional should really be advising you what to do.
Okay. All right.
I also want to mention this, that I have written, I'm going to mention this website, that if you go to this website that I write a column every week, I've written both about IRAs, Roth IRAs, and QCDs. I'll say the website very slowly so everybody hears it. If you go to www.myfederalretirement.com, that's one word, myfederalretirement.com, and you can Google my name, Ed Zurndorfer, or you can Google QCDs, IRAs. You can see all the things I've written about. It's all there for you, for your bedside reading. Everything is there, okay? Everything you want to know. I try to write, the way I write is I want to make it understandable, okay? I'm not trying to impress, the hierarchy up in the CPA world. I'm trying to write so everybody understands it, okay? So please, myfederalretirement.com.
Okay. All right. Thank you. Next question, or it's kind of in a way of comment, but also maybe you can give us some background on this, why this is, or why this legislation brought us to this point. The imposition of the 10-year requirement on non-spousal IRA beneficiaries appears to me to be incredibly mean-spirited, especially for those of us bequeathing everything to kids and grandkids. Am I missing something? Why?
Without trying to be political here, I just want to mention some of the reasons why Congress did this. One of the reasons, and the person makes a very good point, I'm not arguing, but I guess Congress' intent was that you need to save for your retirement. This should be for you. You shouldn't be saving for generations down the line. They should be saving for themselves for retirement. That was one of the criteria why Congress did this. Okay, you notice for these eligible designated beneficiaries, they still are including the people who may really need this money, like disabled individuals. They didn't rule out everybody. Spouses are certainly going to be entitled to do these lifetime distributions, but I think Congress' intent was they didn't want the so-called rich people giving their grandchildren lots and lots of inheritance, so the grandchildren wouldn't have any incentive for them to save for their retirement. I guess that was one of the reasons. Again, I'm trying to give my explanation, and this is by no means a political statement, please. Okay, so that's on the rationale. I to a great extent, I agree with the person's statement. Okay.
What wasn't the ceiling on what you can bequeath to your kids, just like property and so on? Wasn't that just raised over the last few years?
I mean, in terms of the gifting?
Yeah. Well, I don't know. Like if you have two houses, your kids, you're the general worth of your estate if you die. Hasn't that ceiling been raised?
Oh yeah, well the federal estate tax, again, I mentioned it's $11.8 million, $23.6 million for married couples. And again, it's been raised through the years. So I mean, again, there are opportunities to give to the next generation. But again, I think that We have to, this generation now who's on the verge of retirement, we got to think about we're living longer now, and we just can't give away our assets knowing that we may not need them down the line. We have to be very careful here.
Right. Okay. Thank you, Ed. There's more. There's quite a few.
Good.
Regarding the no age limit for traditional IRA contributions, if still working, what does working mean? For example, how about part-time gigs here and there? Is that working? And then, I don't know if you know, in the foreign affairs agencies, we have the ability to get rehired back under special circumstances. It's called the WAEREA program, where we work part-time and
Yes.
get hired back, but there's a ceiling on how many hours. So the person who asked the question, asked specifically, okay, what if I do that?
Good question. And my answer is, if you're getting a W-2 statement of wages in January, that means you were working. Or if your spouse is getting a W-2. Now, I want to be very specific in terms of how much you can contribute to an IRA. And let's talk about 2019, because ladies and gentlemen, we're going to find out very shortly when we talk about the CARES Act, we still have time to contribute to an IRA for 2019. The filing deadline for 2019, for tax year 2019, is July 15th. That's what, 3 weeks from tomorrow? You still have time to contribute. Now, who can contribute to an IRA for 2019? Well, go back to this past January. Did you get a W-2? Did your spouse get a W-2 in 2019? That means that you're eligible to contribute to an IRA for tax year 2019. Now, you mentioned, Doris, about part-time work. You can contribute to an IRA for 2019. The lower of $7,000, let's assume you're over 50. You're over 50, or 6,000 if you're younger than 50. If you're younger than 50 as of December 31st, 2019, or 7,000 if you're over 50. You were over 50 as of December 31st, 2019. The lower of whatever shows up on box 1 of your W-2 gross wages, or the $6,000 or $7,000, whatever's lower. What about if you were retired from the Foreign Service during 2019, but you had, let's say, your own business? You had a Schedule C, self-employed. If you had a net profit from your business, then you can put in the lower of your net profit from Schedule C, or the $6,000 or $7,000 into an IRA. Okay, I call earned income the sweat income. You have to earn it. Okay, it's not passive income. It's not interest. It's not dividends. It's not a pension. It's something that you have to earn. You have to show up. You got to produce. You really have. It doesn't come to you automatically. You have to produce. I've talked to federal employees and they say, well, I'm going to retire on December 31st, 2020. So I guess 2020 is the last year I can contribute to an IRA. It's not true, because if you retire, let's say on December 31st, 2020, you're going to get a paycheck. You're going to get at least one paycheck dated sometime in January 2021 for pay period 25 that occurred in December 2020. You also are going to get paid for your unused annual leave. And that unused annual leave, by the way, is considered to be earned income. It's going to show up on a W-2. Mm-hmm. So there are many ways that you can have earned income that will qualify you to contribute to some type of IRA.
All right.
Okay.
All right. Here is one. I don't have children. Could I give $15,000 a year to nephews or nieces?
The $15,000 per year per individual is to anyone. Oh. You can give $15,000 to your niece. You can give $15,000 to your nephew. You can give $15,000 to your cousin. There's no limit as to the number of individuals that you can gift to, and the $15,000 overall limit. There's only one person. There is no limit as far as how much you can give, and that is your spouse. You can give unlimited amount of money to your spouse in terms of gifting. Okay,
All right.
okay. But the answer to the question is to niece and nephew, absolutely.
That's good to know.
And not have to file the form, the IRS Form 7 or IRS Form 709.
Okay. So the next question, does the thrift savings plan have anything equivalent to the stretch IRA with a 10-year payout to beneficiaries? And you may need to explain that too, to people what that is.
Okay, the TSP has no such things as a stretch opportunity. The rule is this for the TSP, and this is true whether it's a traditional TSP or the raw TSP. You can name anybody as you want as beneficiary of your TSP. It could be a spouse, it could be a child, it could be a grandchild. But if you name a non-spouse as beneficiary of your TSP account, then the rule is the non-spousal beneficiary must withdraw the money from the TSP account within 5 years of your death. The only thing that this non-spousal beneficiary could do is to tell this TSP that he or she wants to have their inherited TSP account directly sent to an inherited IRA. If it's a traditional TSP account they're inheriting, it can be directly transferred to an inherited traditional IRA. If it's a Roth TSP account, it can be directly transferred to a inherited Roth IRA account. And once it hits this inherited account, then we can have the stretch business of 10 years, the trend, 10 years. A spousal beneficiary of the TSP is allowed to keep the money in the TSP. They don't have to withdraw it within 5 years. The only requirement is that when the spousal beneficiary reaches 70 and a half, or 72, depending on what year they're born, because the law has changed, okay? Mm-hmm. They have to start taking their RMDs. So there is a way, Dolores, that a non-spousal beneficiary of TSP can get this 10-year stretch, but they got to do a little work because the TSP does not do the 10-year stretch. All the TSP says is you must take the money out within 5 years. And if you don't, they're going to pay it out. They're going to just send it out to you if you don't take it out after the 5th year anniversary of the TSP the owner's death.
Okay. All right, here's a COVID-related question. How do you need to document a COVID-related need if you choose to take up to $100,000 out of your traditional 401k or thrift savings plan regular account? How defined are these parameters?
The TSP just came out with some regulations. They're up on their website. I've not read through all of them, but I'm just going to read what I have right here. Who qualifies for these so-called tax-free? Not tax-free. Penalty-free distributions up to $100,000 from the TSP. It's individuals whose spouse or dependent has been diagnosed with COVID-19. Individuals who've been quarantined as a result of COVID-19. This would not apply. Any federal employee with a TSP account has been furloughed. I don't think that's the case, or laid off. I don't think that's the case. Okay. This may apply that if you're a federal employee with a TSP account and you have not been able to work because of lack of child care, you have children, you would qualify for these penalty-free distributions. And of course, if you yourself have been diagnosed with COVID-19, then you'll be able to take this money out. But ladies and gentlemen, I emphasize, this should be the very last resort. I hate raiding one's retirement account to pay for such a thing. You know, thank God we still have jobs. Federal employees have not been laid off. You know, we should do everything in our power not to raid the TSB to pay for any expenses, to take out loans, because it's just you're just going to be ruining what's going to happen in the future. Thank God the market has come back. I mean, the stock market's come back. It was bad in March, but it has come back. And I'm just advising people, stay the course. Do not panic. Just hang in there.
Okay. All right. Here's a rather general question. I'm retired and over 70 and have been told that there are advantages to taking my money out of TSP and putting it in an IRA, not a Roth. I'm not clear whether there is any such advantage. Can you advise?
One advantage if you're over 70 and a half is that we talked about these QCDs, that this way when you have to take your RMD, you can get around the RMD, not have included income by doing the QCD. If you had it in the TSP, you couldn't do that.
All right. We're having some people popping in and out. Would you just remind everyone what a QCD is?
Qualified charitable distribution.
Okay. All right.
Okay, sure.
Yeah. Okay. All right. Now, I think that we got to this question, but I want to make sure. In the beginning of our question and answer period, we were talking about giving a grandchild $60K lump sum. I wasn't sure at first. I think you thought it was a child. Did you answer about a grandchild?
That was 60,000. I think Dolores was going into their 529 plan for a grandchild, grandparents.
Yes.
That's perfectly okay because they can give up to 5 years worth of gifts into a 529 plan.
Right. Now, I also want to say to the audience, we have the benefit of having Ed with us for up to another 45 minutes or so. So, keep the questions coming. Please send them to Christine Mille, and she's feeding them to me. Okay, now, next question. Do you have to convert 100% of your traditional to a Roth? I heard that I can't have both and would need to convert all traditional to Roth.
You can have as many IRAs as you want. You don't have to, if you want to convert your some of your traditional IRAs to Roth IRAs, you can. You don't have to do all of them. However, I caution people that you can't. The IRS doesn't allow you to cherry pick which traditional IRAs, you're going to convert to Roth IRAs. They're looking at the whole picture. And getting back to what I said a few moments ago, before you do any conversion of your traditional IRAs to a Roth IRA, please consult with a qualified tax professional to talk about some of all the advantages and disadvantages, what you have to know. I've seen too many people get disappointed, upset because they did the wrong thing. So before you do anything, ladies and gentlemen, before you do any conversion of your traditional IRAs to Roth IRAs, please consult with a qualified tax professional.
Okay. All right. This is a follow-up question to the still working and your comments about the W-2. You said that pay must be on a W-2. What if you get a 1099 MISC, miscellaneous?
So if you got a 1099 miscellaneous, I assume that you're a contractor, maybe? You work for someone?
Could be. I'm not sure all the different categories of employees that get that.
Let's say you did some consulting in your business, so you got a 1099 miscellaneous, let's say for $4,000. I don't know, I'm throwing out a number here. And where did you report that 1099 miscellaneous? If you reported on Schedule C, self-employed, a sole proprietor, and then you had any expenses associated with your business, maybe travel, maybe supplies, maybe books, something that, computer, And when you added up all your expenses, it came out to be $1,000. So here you got income of $4,000, expenses of $1,000. Now you net from your business $3,000. You have a net profit of $3,000. So that $3,000 is considered to be earned income. That can be used as a basis for contributing to an IRA, a traditional or a Roth IRA. But keep in mind that even though the limit is $6,000 or $7,000 for the year 2019, you only can put in the lower of whatever your net profit or earned income was for 2019, or the $6,000 or $7,000, depending on your age. In this case here, it's $3,000 because that was your entire net income.
And that's without an age limit, correct?
That is without. Now for 2019, it is an age limit for 70 for a traditional IRA. For 2020, no age limit. We still have time to contribute to an IRA for 2020. That deadline is April 15th, 2021. For 2019, the deadline is July 15th, 2020. But anybody who was over 70 and a half during 2019 cannot contribute to a traditional IRA if they're over 70 and a half. Okay, that's going to take effect in 2020.
Okay. All right. Next question has to do with taxes too, taxes and death. What are the tax consequences for a person who inherits a TSP or an IRA upon my death, like my children or my spouse?
Well, we have to distinguish between the traditional TSP, traditional IRA versus Roth TSP, Roth IRA. With traditional TSP, traditional IRA, the tax consequences are that a non-spousal beneficiary, like a child, has to take the money out. You have to take it out within 5 years and pay tax. Now under the stretch IRA rules, you do have a 10-year limit now with the stretch. But there is no annual RMD under the Secure Act. You have to take the money out if you're not an eligible designated beneficiary. You got to take it out within 10 years, but you don't have to take an RMD within during each of the 10 years. After the 10-year anniversary of the death of the IRA owner, yes, you got to take it out, everything. And I advise people, don't wait till the end of the 10 years in the case of a traditional, because you're taking out a lump sum. It could push you into a higher tax bracket. That is not the case with the Roth. Because with the Roth IRA distribution, the money coming out will be tax-free. So the longer you wait to take the money out of the inherited Roth IRA, the more money you probably will have. It's unfortunate you got to stop it after 10 years. 10 years.
And that's for non-spouses as well?
That's all non-spouses divorce, because we're talking about non-eligible designated beneficiary. A spouse can keep the money in there. Okay?
Right.
Okay. But somebody who's not an eligible designated beneficiary, such as a child who's over the age of 18, a grandchild, again, once they reach 18, then they got to take it out within 10 years. 10
Right,
years.
right. Okay. Here's the next question. If we take out 80,000 via the CARES Act, can I then pay back via my E-Trade Roth IRA account? I have to say I'm not a specialist. I don't understand the implications of that question. So
I'll tell you what, Doris, can we hold that question, because we haven't talked about the CARES Act.
Okay. All right. Okay. Let's see. People have been popping in and out, and we may have dealt with this in some way, but I'll ask it again. This is very dense material, and it's a new question. Do we get tax consequences if we withdraw funds from Roth IRA and not traditional IRA?
Are there tax consequences for withdrawing money from Roth IRA? Is that the question?
Yes, and not traditional IRA.
In order to not be taxed on a Roth IRA distribution, an individual has to fulfill two requirements. We're talking about a Roth IRA here. Before I go to the requirements, I just want to mention one thing. Just recall that when you contribute to a Roth IRA, the contributions you made were always with after-tax dollars.
Mm-hmm.
You're getting no tax break by contributing to upfront when you contribute to a Roth IRA. So when you withdraw that money, those contributions from a Roth IRA, they're never taxed. It is the earnings that grow inside the Roth IRA we're talking about when do you not pay tax. So in order to not pay tax on the accrued earnings in a Roth IRA, you must fulfill two requirements. One, you have to be over age 59 and a half. And two, it must have been at least 5 years since January 1st of the very first year you made a Roth IRA contribution. Roth IRAs have been around since 1998. So let's suppose you made your first Roth IRA contribution on June 23rd, 2005, exactly 15 years ago it was. And right now, you're 65 years old, just throwing out an age here. And you would like to take money out of that Roth IRA. Will you have to pay tax on the earnings? Let's talk about it. Are you over 59 and a half? Yes, you're 65. Has it been at least 5 years since January 1st, 2005? Absolutely. So now you can take the money out of the Roth IRA and not have to pay tax on the earnings. It is what is called a qualified Roth IRA distribution. Now, I promised everyone earlier, now I got some time, I'll just follow up on this. Remember we were talking about the Roth TSB, Dolores?
Yeah.
The Roth TSB, that the Roth TSB is subject to required minimum distributions. People think, oh, I'm going to put money into the Roth TSB, and this way I won't have to take the money out because the Roth TSB is not subject to RMDs. That's not true. The Roth TSB is subject to RMD. Is there any way around that? And the answer is yes, because when an employee retires from federal service and they have a Roth TSB account, or if they're still in federal service and they're over 59 and a half, they are allowed to directly transfer their Roth TSB account to a Roth IRA with no tax consequences. Now, what's the advantage of that? Let's suppose you're now 65 years old. You got this Roth TSB account. You realize that 7 years from now, what do you have to do with that Roth TSB account? You got to start taking RMD.
Right.
Well, if between now and age 72, you tell the TSB, I would like to transfer my entire Roth TSB account to a Roth IRA. If you do that before you reach the age of 72, guess what? You do not have to take any RMD from the Roth TSB. It's not inside the Roth TSB. It's inside the Roth IRA. This way, it keeps growing and growing and growing tax-free. Until when?
Okay.
You die. If you're married, you can name your spouse as beneficiary of your Roth IRA. They keep it. It keeps growing. But then when the spouse dies, give it to who? Children? Beneficiaries? Will they have to take RMD? Yes. And under the Secure Act, they have to withdraw the money within 10 years. All right. So they got to take it after 10 years. Will they have to pay tax? No. You've given your children, or if you want to maybe give it to your grandchildren, a tax-free gift. It's a strategy to think about for those of you who have the Roth TSP.
Okay, interesting. Okay, since we are talking about RMDs, I have a question. The person does not give his or her age, but says, I'm eligible for an RMD this year. Do I need to take it? I'm concerned about keeping a steady income stream so that I don't get a big lump sum next year. It's a simple, or I guess traditional TSP account that my kids would inherit.
I'll tell you what, Loris, since that deals with the CARES Act, can I get into the CARES Act now? And I'm going to answer that question. Just you keep that. That'll be the first question. Okay?
Okay.
Great question, because it's up on the screen here, the CARES Act. So I'm going to continue now with the CARES Act.
Okay.
All right. So we finished off with the Secure Act. Now we're going to talk about the CARES Act. The provisions out of the CARES Act. The most important provisions coming out of the CARES Act that affect federal employees. Probably, I think the biggest one is that the deadline for filing 2019 income taxes was extended 3 months to July 15th. If you have not filed your 2009 federal, and probably in almost every state that has a state income tax, this is also true, you have until July 15th to file your 2019 federal and state income tax return. Even if you owe money, you're not going to be penalized. The deadline now is July 15th. But that also has consequences as far as other benefits of filing, of extending. There are other benefits of the extension of the filing deadline. If you've not made your IRA contribution for 2019, traditional or Roth IRA, you still have until July 15, 2020 to make your IRA contribution. Now the question comes up to me many times, oh Ed, I already filed my 2019 returns. I guess I can't make a contribution to an IRA. Wrong. Even if you filed your 2019 returns, you still are able to make a contribution to an IRA for the year 2019. Just one word of caution, that if you're going to make this IRA contribution for 2019, please tell your IRA custodian that it is for the year 2019. They're going to say, well, this is for 2020, right? No, it's for 2019. It makes a difference because your IRA custodian is also accepting contributions for the year 2020. So you got to be very specific. This is for 2019 and not for 2020. Some federal employees have what's called health savings accounts, HSAs. This is not flexible spending accounts. These are health savings accounts. And you can make your own contributions to each HSA, and these contributions that you make up to the limit, I think it's $7,000 if you're married, and I think it's $3,500 for 2019 if you're single, are considered to be adjustments to your income. It's on your tax return. It's an adjustment to income. You have till July 15, 2020 to make your HSA contributions for 2019. We talked about the 529 college savings plans. There's other types of educational savings account. One is called the Coverdale Educational Savings Account. It used to be called the Educational IRA. You can make a contribution to that IRA for 2019. Also, the deadline would be July 15, 2020. I just want to mention one other thing here, that if you feel that you're not going to have enough time to file your 2019 taxes, you still need some more time. That's okay. You're going to have to go through the usual in terms of filing for an extension. Your taxes will then be due on October 15, 2020. If you're going to make an IRA contribution or an HSA contribution, the deadline is still going to be July 15th. They do not extend the IRA contribution deadline if you're filing an extension personally for your taxes. Make sure that you file for an extension if you owe. If you don't think you're going to owe, you're going to get a refund. You don't have to formally file IRS form 4868. Okay. All right. Now this will get into something that many people are very, very curious about, and that is the CARES Act waived the required minimum distributions, 2020 required minimum distributions. A lot of questions about this. Okay, so let me explain what's going on here. If an individual had an RMD due in 2020, example, let's suppose somebody, an individual, was born before July 1st, 2000, I'm sorry, July 1st, they were born before July 1st, 1949. Okay? And if you do the math here, they had an RMD due in 2020. In fact, if they were born between I think July 1st, 1948 and June 30th, 1949, their first RMD was due on April 1st, 2020. They and anybody else who had an RMD due in 2020 is not obligated to take out the RMD. And if they don't take out their RMD, they're not going to be penalized. Ladies and gentlemen, I just want to do a little aside here that the penalty in any given year for not taking one's RMD, and again, the RMDs, required minimum distributions, are for any type of qualified retirement plan, a 401k plan, traditional TSP, Roth TSP, traditional IRAs, 403B plans, 401k plans. The penalty for not taking one's RMD in any given year, but not this year, but in previous years, is 50%. That's 50. If you were supposed to take out $5,000 as an RMD and you didn't, IRS will assess you with a $2,500 penalty. But for 2020, there are no RMDs. Now, people say to me, well, that doesn't affect me because I'm way under 70 and a half. Think about what we talked about a few moments ago. Suppose you inherited an IRA from mom or dad. Mom or dad died a few years ago, and you were the beneficiary of their RMD. Remember we were talking about the stretch RMD, the stretch IRA?
Yeah.
You are obligated each year to take out an RMD. I don't care what your age is. You could have been 35, 45, 55. You inherited that IRA from mom or dad. You had to take out an RMD every year. Well, with the CARES Act, you don't have to take an RMD out in 2020. So it's not just not taking out the RMDs affects not only people who own retirement accounts or traditional IRAs, it affects a lot of people who are the beneficiaries of inherited, who are the inherited IRA beneficiaries. Now, this has caused a lot of confusion. And to understand the confusion, I'm going to concentrate on the TSP. I've always maintained, getting back to the 50% penalty, that no federal annuitant will ever pay a 50% penalty to the IRS because they did not take an RMD from the TSP. And people say to me, how can you be so sure? You don't know me. I tend to forget. I know I'm going to forget to take out my RMD from the TSP. Well, you're not going to forget. Reason being that the TSP has a policy that the year that you turn 70 and a half, and it will be starting the year you turn 72 for people born after June 30th, 1949, that in January of every year, you get a notice from the TSP telling you what your RMD is. And they will tell you, this is your RMD for this year. And a lot of people say, fine, and they may put it aside, and they may not do anything. And come the following December, they haven't done anything. Well, come probably around December 15th, something's going to show up in their mailbox. It's going to be a check from the TSP, because the TSP will automatically do the RMD for you and send you a check. For people who turned 70 and a half, who had TSP accounts, retired from federal service during the year 2019, their RMD were due by April 1st, 2020. If these individuals did not take their RMD as of January 1st, 2020, the TSP has a policy that they're going to send the RMD to this individual by March 1st, 2020. The CARES Act was enacted on March 27th, 2020. When the CARES Act was enacted, that's when Congress said no RMDs are necessary. So Congress gave us a nice little gift there. But what about the people who already taken their RMDs though? There are individuals who had taken their RMDs, between January 1st and March 27th, including some TSP beneficiaries. Well, IRS gave some relief. These individuals were allowed to roll over their RMDs back into their retirement accounts. IRS came out with a ruling in April saying that anybody who took an RMD, who was forced to take an RMD, who was given an RMD, whatever, between February 1st, 2020 and May 15, 2020, can put the money back into their accounts. And this way, they will not have to include it in income. This was a gift, in my opinion, from IRS. This morning, the IRS made another announcement. The original deadline for rolling over their RMDs was July 15th. This morning, it was extended to August 31st, 2020. So anybody who took their RMD anytime between February 1st and May 15th has until August 31st to roll over that money either into a traditional IRA or back into the TSP. Let's do an example here. We have Janet, who's a federal annuitant and a TSP participant. She was born on May 30th, 1949. Now, since Janet was born before July 1st, 1949, and is retired from federal service, Janet's required beginning date for TSP is what? April 1st, 2020. Why is that? Because she was born before July 1st, 1949. As of February 1st, 2020, Janet had not taken her first TSP for 2019. Under the CARES Act, Janet does not have to take either her 2019 TSP RMD. When does that due? April 1st, 2020. But wait a minute, what about 2020? Remember, Janet's first RMD was for calendar year 2019. She still has to take an RMD for 2020, but under the CARES Act, she doesn't have to take the 2020 RMD. And her first RMD will be in what year? 2021. And people are thinking, whoa, that means she's going to have a big RMD. She has a couple years worth. Not necessarily, because you got to remember that the RMD is based on two things. One's life expectancy, and two, the account balance as of the preceding December. So there's a good chance. I mean, it could be a nice amount, because you got to think the markets were in pretty good, had gone up pretty much on December 31st, 2019, before they came down. So she'll have a nice amount. She'll have a nice amount of R&D for 2020, but not that bad. I mean, it will not be. She's not going to pay twice as much. Okay. Here we have example 2. Randy, age 42, a federal employee. Randy's mother died in 2017, and Randy was named as beneficiary of his mother's traditional IRA. Randy elected to have the IRA directly transferred to this inherited death IRA, in which the IRA was paid out to Randy over his life expectancy via R&D each year. For the year 2020, no R&D needs to be taken. Okay. R&Ds previously taken this year in 2020 can be undone if R&Ds are eligible to be rolled over. The rollover must be within 60 days of the day R&D received, but IRS changed that, saying now any R&D was taken between February 1st and May 15th has extra time. It says on the screen July 15th. If you downloaded the slides and they're printed out, you can cross out July 15th and put August 31st, 2020. One word of caution: IRS has a rule that they only allow you one rollover every 12 months. That is, you can only do one rollover from a traditional IRA to a traditional IRA, or Roth IRA to Roth IRA, every 12 months. What that means is that, let's suppose you did between February 1st and 2020, you had, let's say, a TSP RMD. It was taken out, and then you had a traditional IRA RMD. And you want to roll over both. You want to roll over the TSP RMD to an IRA, and the traditional TSP to an IRA. You cannot do that because you're only allowed to do one every 12 months. Now, what you could do is you can certainly do the traditional IRA the RMD, traditional IRA RMD, roll it over back to the IRA, and with the TSP, you can just roll that money back into the TSP. Non-spousal beneficiaries cannot undo RMDs from inherited IRAs. We're talking about the death IRAs. If they did, in fact, with these inherited IRAs, lifetime RMDs, they already did it, they cannot be undone. The CARES Act, continuing, allows retirement plans, including the TSP, to offer temporary loan and withdrawal options to TSPs who are affected by the coronavirus. Relief is available for individual retirement plan participants if a spouse or a dependent, are diagnosed with the COVID-19. I was talking about this earlier. They experience adverse financial consequences from being quarantined, furloughed, or laid off, or getting reduced. These are individuals who can take money out of their accounts, withdrawals, penalty-free, where they can take out loans that they do not have to pay back. They can suspend the payments. TSP is allowing that. For affected individuals, the maximum amount of plan loans is increased from $50,000, and this is the TSP again, to the lesser of $100,000, reduced by any outstanding loans or 100% of the account balance, whatever's less. The deadline for applying for a TSP loan with the increased maximum is September 18th. If you're going to take out a TSP loan, you have until September 18th, 2020. The deadline for applying to suspend the payments. If you want to suspend payments on this loan or a previous loan, you have until November 30th to apply for suspending the payments. I want to emphasize, when you suspend the payments, you do not suspend the interest. The interest will still continue to accrue on the unpaid balance of these loans. I'm not a big fan of this. An eligible TSP participant may suspend his or her obligation to make payments on his or her TSP loan or loans for 12 months. This will also extend the term of the loan for 12 months. The loan extension applies to existing loans, the loans you had before the CARES Act, and loans taken out for the remainder of 2020. The deadline to apply for loans for TSP loan extension is November 30th, 2020. Gotten questions? Can I take out an IRA loan? Nope. IRAs do not allow for loans. If you're going to take a distribution, you're affected by the coronavirus, you want to take a distribution, the early pre-age 59 withdrawal penalty of 10% is waived for up to $100,000 of 2020 distributions from IRAs and retirement plans, including TSP for coronavirus-related distributions. Federal income tax would be due on the distributions, but you could pay the tax due on the distributions over 3 years, starting with the individual receives the distribution. State income tax is also due. Affected individuals over age 59 and a half can still take advantage of the 3-year income tax deferral and 3-year payback. A qualified individual made a coronavirus distribution from an eligible retirement plan, such as the TSP, may repay all or part of the distribution to any retirement plan. You don't have, if you took it out of the TSP and you want to pay back, let's say, a 401k plan or an IRA, you can do that. It does not have to go back into the TSP. If the coronavirus distribution is repaid, the original distribution will be treated as though it were repaid in a direct plan-to-plan transfer, so that the individual will not owe federal and state taxes on the distribution. So if you took the money out of the TSP, but you paid back your old 401k plan, the TSP is not going to tax you on the distribution. All right, one last topic here. Planning, and then we're going to take more questions. Ladies and gentlemen, you have to agree the stock market is down. Stock market this year hit a high on, I think it was February 12th. It was up to over 29,000. It's come back. It's not come back to where it was. I want you to think about it. Here's a question. Let's say you have a traditional IRA. You've had this traditional IRA for years. It's invested in equity, stocks. Back in February, early February, it was sky high. It came way down in March when the COVID-19 crisis pandemic started in this country. Okay. Also, a couple years ago, tax rates came down. When is a good time to think about a conversion of a traditional IRA to Roth IRA? When the market is up, when tax rates are up, or when the market is down and tax rates are down? I think it's the latter. I think the best time to convert a traditional IRA to a Roth IRA is that when the value of your IRA is down and you would pay less in federal and state tax. And now might be that time. Remember that the current lower tax rate environment is not going to last forever. The Tax Cuts and Jobs Act of 2017 lowered tax rates, but individual tax rates, but only temporarily. Because come January 1st, 2026, tax rates, federal individual tax rates will revert to what they were back in 2017, inflation adjusted. We are right now we're paying less in individual taxes than we probably ever will. So if you have an opportunity to convert a traditional IRA to a Roth IRA, and especially if the value of your Roth IRA is down, the value of your traditional IRA is down, it's something to think about, between now and the end of this year. Now, if the market goes back up significantly, maybe not. But I think right now, when the market is still down at probably about 10%, the market's come back, but it's still down about 10%, it might be something to think about here. A downward or depressed market should not deter a traditional IRA from converting a traditional IRA to Roth IRA. On the contrary, a depressed market can be an incentive to perform a Roth IRA conversion, because the IRA owner should end up paying less income tax as a result a stock portfolio that has decreased in value. I know this sort of goes contrary to what people think. Well, I know when the market was high, and people think, God, I'm paying so much in tax. I know the market is way up, and I'm getting all these dividends and capital gains, and I'm just paying so high. Is there anything I can do to pay less in taxes? Well, you know, right now, probably not. But if the value of your portfolio is down, it might be a good time if you're talking about in terms of your traditional IRA to convert. And if you're talking about a non-retirement account, it's a good opportunity to buy. Ladies and gentlemen, you know, I run a business here. My wife and I work together, and when I did our taxes, I have a retirement account that I put money in mainly for her as my employee. And I mean, don't laugh, but when I filed our taxes on March 19th this year, one of the things I did was to put like $30,000 into her SEP IRA account. And that time, the stock, I think the Dow Jones was 18,000. She says, "Are you crazy? Putting money into this market?" I said, "Linda, the market is way down. It's a buying opportunity. You're always pushing me to buy things on sale." Well, I just did. And now the value of that account, when I showed her what the account was worth on May 31st, a few weeks ago, it went up close to 22%. Her eyes popped out. Over the period of time between I put the money in and May 30th, it's going up 22%. It's a buying opportunity. So, ladies and gentlemen, it's a good time, and I want to show you here what the current tax rates are. These are the current rates in 2020. They've gone down a little bit from last year. The brackets have expanded a little bit for the lower rates. This is a good opportunity if you have an IRA, a traditional IRA especially, to think about converting it to a Roth IRA. But again, only work with a professional, a tax professional who can guide you. You've got to be very careful. Okay. And one last thing here about the Secure Act. We talked about the end of the stretch IRA. In terms of converting your traditional IRAs to Roth IRAs, if you want to give your traditional IRAs, if you want to give your TSP accounts to your children, maybe they're going to transfer it over to a inherited IRA and get the 10-year payout. That's fine, but I want you to think about something in terms of what your children and grandchildren are going to be facing in the future. And that is that tax rates are going to go back up. What I showed you before on the previous slide, those rates are only temporary. In fact, as I mentioned a few moments ago, January 1st, 2026, they're going to revert to what they were in 2026. So if you end up bequesting your traditional accounts to your children, grandchildren, and they got to take the money out within 10 years of your death, they're going to be paying more in taxes. What I'm saying is that maybe you should think about converting your traditional accounts to Roth accounts, to Roth IRAs now, take advantage of the low rates so that when they inherit your Roth accounts, they don't have to worry about taxes. Yes, they got to take it out within 10 years, but they won't have to pay any taxes. You're going to pay the taxes at a low rate compared to what they would pay if they had inherited traditional accounts. Just something to think about. Okay. Dolores, I am open for more questions.
Okay. We have a little less than 10 minutes left. And so we'll dive right in to the person who mentioned that she wanted to hear again about why it is an advantage to take a Roth I want to say, and I feel your pain in that it is hard to keep up. This information is very dense, but what I wanted to tell you is that it's going to, the recording of this is going to be on AFSA.org in the near future. So you can, re-listen to the parts that, that you want to. So I wanted to say that. And for the person who wants some general retirement information, I can help you. Just email me. I don't have your name here at brown, like the color, at afsa.org, and I can hopefully point you in the right direction. So here we go. Back to that one question about the person who wants to take 80K out via the CARES Act. Can he or she then pay back via an E-Trade Roth IRA account? I'm not sure that we covered that specific.
If it's coming out of the traditional account, Dolores, that's where they're getting the 80,000 from.
It's not defined.
No, they can. If it's coming out of a traditional account, they can't pay it back to a Roth account. It has to be apples to apples.
All right.
Okay.
Next question. I'd signed up for monthly thrift savings plan RMDs in 2013. This year, under the CARES Act, I asked TSP to lower those. Will TSP recalculate the automatic monthly RMDs for me for 2021? I seem to remember someone asked me this before, and my understanding is that they don't. But please,
they're not obligated. I mean, if you ask them to recalculate them, I guess they will. But again, you don't have to take them. I mean, you can, don't get me wrong, but you don't have to. You can suspend the payments for all year. I mean, if the person needs the money, that's one thing. They'll send, unless you tell them not to send it, they're not going to, they will send it. Okay. Whatever they calculated, let's say in January for RMDs, that's what they're going to send you. But if you say stop sending them, and it's your RMD, then they will, because this is for this year. But starting in 2021, they're going to start up again with the RMDs.
Right. Okay.
I want to emphasize, ladies and gentlemen, it's an option not to take the RMD. You can take out as much as you want. Okay.
Okay. All right. For early COVID-related distributions, are there any limitations to the amount we can withdraw, like hardship withdrawals, other than $100,000? Can we withdraw our entire vested amount or only our contributions?
I think it's the lower of, I got this slide up here. I always can't. Okay, maximum amount is the loan. Oops. I think it's up to $100,000. $100,000.
Okay.
As far as vested, as far as vested, TSP participants are vested 100% in their entire account, assuming they've been in the government for at least 3 years. They were in the government for what? I think it's 3 years. They're vested 100%. So the limit's $100,000.
All right. But they can withdraw their entire vested amount or only their contributions?
That the vested amount, Dolores, includes their contributions, accrued earnings, and matching and automatic contributions that the agency made. Okay. But again, it has to be a COVID-19 related distribution. It's not automatic. You have to qualify for this.
All right.
The reasons I stated.
Okay. I took my RMD for 2019 in 2019 and filed and paid tax on my 2019 return. Can this RMD be rolled back?
When did you take it?
2019.
I know. Oh, 2019?
Everything's 2019.
So the person took it in 2019.
I took my RMD for 2019 in 2019.
No, it cannot be rolled back.
Okay. What are the benefits of not taking an RMD this year? If my RMD will be higher next year, do I gain anything?
The advantage is by not taking your RMD, that money stays in there. It gets earnings. You don't have to pay tax. Okay. Yeah, chances are you probably have to take out a little more in 2021. But again, if you really want to get, well, you can't do a qualified charitable distribution. But again, this is just the price you have to pay.
Okay. And I think this will need to be our last question because we're running up to 3 p.m. But we're pretty much through the vast majority of the questions. What is the annual limit for a married couple to use the backdoor Roth IRA?
Say limit in terms of income?
Annual limit. I would assume it's how much they can put in the backdoor IRA, but
okay.
Not specified.
Each spouse can put a maximum $6,000 if they're under age 50, $7,000 if they're over 50 in a backdoor IRA for 2019 and also for 2020.
All right.
Remember, you still have time to do these backdoors and these contributions, backdoor conversions for 2019, for 2009, and of course for 2020.
All right. Well, I think it's time. That was a very rich and dense discussion. I hope that it's been helpful to people. I know there are at least 70 stalwarts who are still with us. If there's something that we didn't cover, that, you're welcome to email me at brown@afsa.org. When I'm looking at the questions, I don't know who has asked them. So, drop me a line and I'll do my best to work with Ed and answer your questions. I want to thank Ed very much for appearing at AFSA virtually again. And by the way, this is AFSA's first live virtual event since we are teleworking. So I think it seems to have gone well. I want to thank Richard Bruner for supporting this. This boomer wouldn't have been able to do it without him. and Christy Mealy, my colleague, who is here helping me field all of these questions. And thank you for being here and for your being AFSA members in retirement. I know most of you are retirees on this. We really appreciate your sticking with us and for your support. And stay safe out there. Thank you very much, everyone.
Thank you again.
Okay, thanks. Bye-bye, everybody.
Bye-bye. Bye-bye.